On March 27th, the United States government activated the CARES Act to bolster healthcare resources and combat the economic impacts of the COVID-19 pandemic. This limited EY special series offers comprehensive, in-depth analysis and insights from EY thought leaders to help you navigate the potential risks and prepare for opportunities created by the CARES Act.
Welcome to all of you who've chosen to join us today and watch our video clip. This is the first clip in a series focused on the impact of the pandemic on our financial services clients. Today's discussion, recorded on March 30th, will focus on the U.S. government's passage of its largest stimulus package ever, the CARES Act. Members of EY's financial services organization will double-click on the issues raised by the Act for our sectors. My name's Brian May. I'm the Accounts Managing Partner for our Americas Financial Services Organization. I will moderate our presentation. And joining me today are Peter Davis, the Consulting Leader for our Financial Services business in the Americas, and Mark Seidenberg, a Principal in our consulting practice and co-leader of EY's Global Financial Regulatory Network. Our intention is to keep these clips brief and focus on the critical points for our clients. So let's jump right in. Hey, Mark, maybe you can get us started by offering some context for the CARES Act itself.
Thanks, Brian. And just to set up our discussion on the implications for financial institutions, thought we'd spend a minute sort of outlining the Act. As you've all seen, the Act passed on the 27th of March. It had bipartisan support in Congress and was signed into law by President Trump. The Act is organized around two broad sections, two broad divisions, with a set of titles. And the key is to understand that these provide support to a wide range of potential beneficiaries: consumers, small businesses, medium and large size corporations, as well as specifically targeting certain industries that have been impacted by the crisis. The Act includes support of direct aid loans, some of which may be forgiven, as well as tax provisions. Probably helpful just to look at how those support is provided and where the support is going. So for that, maybe I turn to Peter.
Thanks, Mark. We've summarized here a very macro view of how the $2 trillion is allocated. And as you step back and think about the Act is really all about providing short-term resources to help us weather the current condition of the health crisis that we're facing in the pandemic. And so the focus of the Act is to get out short-term resources to individuals, to businesses, to directly impacted industries, and specifically to the healthcare industry to be able to help respond immediately to the crisis that we're all facing. If you take a look at how that money is allocated, you can see a significant portion that's being provided as direct aid, whether that's unemployment insurance, whether that's provided to states, whether that's grants, but directly given to individuals and to impacted parties. There is another component, very significant, which is loans to businesses. And I would break that into loans to small businesses, and that's through the SBA program, and then an exchange stabilization fund, which provides some direct aid to immediately impacted industries, but provides a vehicle to provide funding to a much broader set of recipients, but with strings attached. And then there are very significant tax provisions that are provided, again, with a goal of providing immediate resources into the economy. And then as you look across some of these, there are trade-off decisions that one will have to make when you look at what decision is right for your customer, for your employee, and for the institution itself. So for example, as it relates to small business lending, you could receive a forgivable small business loan, but if you did that, you could not take advantage of the employee retention tax benefits or the deferred payroll provisions that are provided in the Act as well. So there are some nuances across these and trade-offs that clearly need to be understood. We pivot here to look at how does this actually get delivered to the beneficiaries themselves. And you can see some goes directly to the healthcare industry, some goes directly to individuals. But what we really wanted to call out here is the role of the financial services industry in supporting the disbursement of those resources and providing advice as it relates to taking advantage of the provisions that are provided to individuals and businesses. And so there has been a tremendous amount of attention to the small business lending that's provided through the SBA. That program is provided through existing approved SBA 7A lenders, and they have a disaster loan program as well. New qualifying institutions can apply to become an SBA lender. In that case, the lenders are moving really at breakneck speed. The SBA itself just released guidance today, so the law was passed on Friday. Today's Monday, and guidance has already come out as it relates to eligibility criteria. They will have more guidance out later this week, and the banks will be geared up to begin to issue loans as quickly as this Friday. And then if you look at the U.S. Treasury, there's $450 billion provided in the Act that, in conjunction with the Federal Reserve, can be levered up significantly to provide resources to impacted industries and to public sector entities as well, which, Mark, maybe I'll turn it over to you to explain that in some more detail.
Thanks. As we look at the Fed financing facilities, this is really an opportunity to drill down, as Peter said, into that bottom lane of how the support is being provided, both to financial institutions, corporations, as well as municipalities and state government. This actually should be familiar to a lot of the participants in this call, as this is the same approach, same structure that the Federal Reserve and Treasury used in the 2008 financial crisis. In this case, there's a fairly common structure, as we saw then, which is using investments by Treasury to provide guarantees or capital to a special purpose vehicle, providing funds from the Federal Reserve to the SPV, and then engaging in transactions with eligible participants. This structure can be very valuable because, as was noted, as you've seen in the public commentary, there are a lot of references to the support being a multiple of $2 trillion, $5, $6, $7 trillion. And that leverage is really achieved through this structure. The critical part of this condition is the ability to both provide support directly to financial institutions, but also for financial institutions, particularly banking organizations, to be help be the transmission from the Federal Reserve and Treasury to potential borrowers. To be fair, there's still some uncertainty. While the Fed has initiated a set of facilities that are very familiar to us from the crisis, there are several that are called out in the CARES Act. For example, providing support to mid-sized corporations, providing support to municipalities as well as state governments that have not yet been designed or implemented. One common theme, one challenge we all face with respect to these facilities is that a lesson from the 2008 crisis is the need to have appropriate oversight for the facilities and the use of funds. Part of the CARES Act included the establishment of a special inspector general, specifically to oversee the distribution of funds that were provided to Treasury, as well as calling for oversight by Congress. Additionally, each of the facilities, depending on the nature of the borrower and the nature of the assets, will have a set of both eligibility requirements as well as conditions. Some of these conditions relate to distribution of capital through share repurchases and dividends. Others may relate to executive compensation. Others may relate to the maintenance of certain levels of employment. What's notable is these conditions may extend even beyond the term of the support that's provided.
Hey, Mark, that's a great overview of these facilities, and Peter, a strong overview of where we think how the funds are going to move from the various titles into the hands of those who need it most. So thank you for that. I think what we do is maybe turn back and dive a little deeper into some of the Act's components that are most relevant for financial institutions. Mark?
Thanks, Brian. And what we presented here is a way of calling out certain aspects of the four titles: small business, worker assistance, healthcare, and economic stabilization, that are most relevant for our clients. First, as you look within small business, this is really oriented to both the beneficiaries of the loans, but importantly, as Peter noted, how support will be provided through the SBA in conjunction with lenders. There are a number of stipulations that are associated with that, as well as consider both for the provision of this support, as well as to the recipients. As we look at Title II and Title III, worker assistance and healthcare, these are a set of considerations which predominantly relate to the customers of financial institutions. Unemployment insurance, tax provisions, healthcare provisions, direct support from the government that will all impact our clients' customers as well as the firms themselves. Importantly, these titles also include a number of business tax provisions. Finally, when we turn to Title IV, which is economic stabilization, are the specific provisions related to the Treasury and Federal Reserve facilities I described, as well as provisions related to direct lending to corporations in impacted sectors. Notably, there's some specific provisions within economic stabilization that's worth calling out here. One is the potential to suspend the legal lending limit that applies to banking organizations. Others are provisions related to forbearance with respect to mortgages, extending the activity that FHFA has been pursuing for the last few weeks in conjunction with the GSEs, as well as credit reporting related to consumer forbearance and the suspension of TDR and in some cases, certain accounting relief.
Thanks, Mark. Those are good components to focus on. And so, Peter, maybe you could tell us, what action should the institutions be taking now?
So if we take that same framework and look at what are the components that financial institutions need to take action on now, I would start with small business. Now that's just within banking that are approved SBA lenders, but there will be others that refer SBA lendings to the approved lenders. So there is significant work, and as I mentioned before, a lot of time sensitivity to getting these programs stood up and getting resources into the hands of small businesses. And as I also mentioned before, there's trade-off decisions where advice needs to be provided for small businesses between taking advantage of tax advantages or loans and grants that are provided through the Act. As it relates to the impact on individuals, there is work to be done as far as understanding what the tax provisions are and how they impact financial institutions directly themselves and how they impact their workforce. There is significant work to be done as it relates to financial advice to financial institution customers, as it relates to the implications of all the tax provisions, grants, loans that are available to them as individuals and as small businesses. And then if you think of this infusion of cash that's going into the economy directly to individuals and to businesses, institutions need to step back and look at what has that done to my risk profile today as it relates to the emerging credit risk, where we were seeing sudden loss of income and creating spikes in the credit risk, default risk of individuals and small business. So how has this temporary funding changed that profile, and therefore the actions that financial institutions need to take to support their customers and to support their investors as well? And then Mark, maybe I'll turn it over to you as it relates to the economic stabilization component.
Thanks, Peter. Maybe I'll start out with some broader macro considerations and then drill into some specifics. As we discussed earlier, there are a number of areas of the Act that impact housing finance. It's important for our clients and financial institutions to understand how those are going to play out through the existing housing finance system, both from respective lenders, GSEs, HUD, and the impact that may have both in the short term and in the long term on credit risk assessments and, importantly, credit losses related to mortgage. Another very broad consideration is the potential role that financial institutions will play in helping to establish the Federal Reserve lending facilities. As we noted earlier, in some cases, financial institutions, particularly banks, will be the direct beneficiary. In other cases, it will be their customers. It'll be a question of how do they grant access or help customers gain access to these facilities. And finally, in some cases, we may see that financial institutions are actually the transmission of those lending facilities. That is, the facilities will provide financing to banking organizations that they will be able to then provide to corporations or state or local government. Focusing in even more particularly, there's no question that there's going to be challenges of implementing the considerations with respect to forbearance from an operations, compliance, and accounting. There are also important considerations on managing corporate credit risk, which includes understanding the restructuring impacts, as well as the potential impact on borrowers' ability to pay as they take on additional leverage or receive grants. And finally, firms should focus on assessing financial reporting considerations. This includes, but it's not limited to, potential changes in accounting, including the option of delaying implementation of CECL.
Well, definitely plenty to do, both Peter and Mark. Clearly, there's a lot of uncertainty still about various aspects of the Act, and critically, the social and economic impact of the crisis itself. So, what advice would you have in terms of prioritization and sequencing of these actions for our clients?
Hey, Brian, and you can see here we've laid this out in a now, next, and beyond framework, but maybe I just pull back first. And we all know that we are in the midst of a healthcare crisis, which has then driven a potential economic crisis. Obviously, the CARES Act is attempting to cushion and offset the economic impact while at the same time providing resources to address the health crisis as well. I think we all need to step back and look at, how are we as institutions focused on creating long-term value? How are we looking at all of our impacted stakeholders, whether that's our employees, our customers, our investors, our broader set of stakeholders, and how are we thinking in their best interest, particularly at this time of crisis? As it relates specifically to the Act, the now activities, this is a complex Act that is vast in its scope, and hopefully you've got a sense from this discussion now, there's trade-offs in there that need to be understood. So clearly there's immediate activities that need to be done to understand the Act, understand the conditions that will be placed on certain types of aid that may be provided, and understand holistically what's there. That information then needs to be available to employees, to suppliers, to customers, to ensure that all of those key stakeholders to your financial institution are able to have the resources they need to be able to operate the way they need to operate, whether that's personally or as a firm. And a key component of this will be, how do we make sure as a financial institution we can make those resources available to the customers who are eligible and who need it. An important component of that will relate to investment and tax advice, as in supporting individuals as they look to manage their personal wealth and take advantage of the options that are there. And as we talked about extensively, it also means making sure that the small business loans can be made available to those small businesses that need it. And maybe, Mark, I'll turn it to you for the next and beyond.
Thanks, Peter. And to be fair, when we talk about next and beyond, we're talking probably weeks and months, not months and years, if you will. First, as we consider the next, there continue to be challenges both from the pandemic crisis as well as specifically related to the CARES Act, as was described earlier, that could impact firms' risk management, their internal controls, and their ongoing operations. Additionally, whether it's for themselves or for their customers, it's important to understand, as you said, and then understand the conditions that may be attached to any support and establish appropriate programs to monitor and report compliance with those conditions. We talked earlier on a few occasions about the role of Federal Reserve facilities and how banks and other financial institutions may be both the recipients or the beneficiaries of those facilities, as well as the important role they may take in transmitting those benefits to customers. Understanding how those will be stood up and the role that financial institutions will play will be important going forward. Picking up on a theme that you raised, understanding and assessing both customers and firms' own tax implications, given the scope of the Act, will be very important. And finally, although we've not really focused on any particular sector yet, there's a lot of uncertainty as it relates to the insurance industry and potential insurance legislation. As we look to the beyond discussion, it will be important going forward to be prepared to demonstrate how the funds, how the support were used to benefit U.S. taxpayers. And to be fair, that's not something that we can just consider in the beyond. It really is a discussion that needs to start today, that is in the now. How will you monitor the use of the taxpayer support? How will you demonstrate the role that financial institutions played in both using the support that was provided to them and the role they played in ensuring that customers benefited from that support as well? That's really not something that can wait truly to the beyond. A few things that will be, other things that will be part of the beyond. identifying and understanding areas that you can pursue cost savings and operating model transformation that really relate to the broader impact of the pandemic crisis we're all going through. Additionally, integrating considerations into strategic planning, scenario analysis, stress testing will be something that we all face as we have a new understanding of what severe but plausible may mean. And then finally, recognizing that some of the compliance obligations extend beyond the term of support, understanding how to manage these longer term implications will be important, including the longer term implications of government oversight.
Hey, Mark, I'd like to go back to the point you just made as far as it relates to the benefits to taxpayers. And I do think we can go back to the 2008 crisis. And if you look at how that unfolded, the support the government provided, but if you look at the aftermath, the number of fines, penalties, reputational damage that was done, I think we can all step back now and reflect on the amount of aid that's being provided here in a time of crisis. Things are moving very quickly, but we all really have to have our eye on who's doing the right thing at this point in time, who's helping ensure that the collective actions across the public and private sector are getting to the right outcome, because it's very clear after the $2 trillion here are spent and even more that we put in to address both this health crisis and financial crisis, there will be a lot of interest on the part of the public to say, who really helped out here and who maybe benefited in a way that seems unseemly or inappropriate as part of that. So I think we all need to think about that as we think about how we're moving from the now, next, and beyond to support the society broadly, our customers, and our people.
Peter, Mark, on behalf of our audience, I want to thank you for sharing these incredible insights today, and all of the EY subject matter advisors who've worked tirelessly to try and bring insights to this web clip as well as to our clients to help support them in this difficult time. I want to reiterate the call there that our financial institutions are in a unique position in the trust in the rollout of this act and the support of the economy as a whole. Thank you again. We will leave it at that. For our audience, if you want to learn more, please go to ey.com. We will be posting not only additional video clips that are related to this series, but all of our thought leadership as it relates to COVID-19 will be housed there. And if you have any specific feedback or questions as it relates to this web clip, please email us or contact your EY relationship partner for additional support. Thank you and stay safe.